Welcome to Commercial Real Estate Pro Network's CRE PN Radio. Thanks for joining us. My name is J. Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's program is sponsored by Building Insurance and Risk. Don't put your real estate investment in peril. Work with Building Insurance and Risk and receive multiple coverage offers with a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Zachary Beach. Zachary is an Amazon best-selling author of the New Rules of the Real Estate Investing and co-host of the Smart Real Estate Coach podcast. He is a partner, COO, and coach at Smart Real Estate Coach. In September 2020, they released a revised edition of Real Estate on Your Terms, which Zach co-authored. And in just a minute, we're going to speak with Zach about Real Estate on Your Terms, how to create continuous cash flow now without using your cash or credit. But first, a quick reminder. If you like our show, CRE PN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We'd love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome back my guest, Zach Beach. Welcome back to CREPN Radio.
Aaron, happy to be back here. And yes, I encourage you to go to the YouTube channel so you can see how handsome we are.
That's right. You got to always little tease there. You got to make sure they know you're wearing your favorite shirt or whatever you got going on there. So, but no, I'm delighted to have you back, man, and looking forward to our talk. Before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Yeah, I'd love to. So Darren, it's certainly been a little bit of time since I've been on, so thank you again. I'm super grateful for being back on here. This is always a fantastic show. Those of you that didn't listen to the first one, I was a bartender and personal trainer coming out of college, and I didn't really know what I wanted to do in life, as I really didn't have a big set goal dream. I just knew I'd love to be successful one day. And when I was about 24 years old, I approached one of the smartest people I know, my father-in-law, Chris, at the time. And I said, hey, I know you're reinventing your business because you just got out of the 2008 crash. And I said, I know you're reinventing your business in real estate. And hey, I don't know if I'm going to like real estate at all, but I know it's going to be a heck of a lot better than staying up late at night, serving drinks, and waking up super early in the morning, training people who didn't want to be trained. Because that's primarily what personal training is. You're training people who don't necessarily want to see results. They just want to pay you to wake up in the morning with them. So I reached out to him and we had that conversation. So I added another thing onto my plate. So now instead of staying up late and waking up early in the morning and then sleeping during the day, I now was making cold calls to expired listings during the day. Or reaching out to people that were on the market at one point in time with a realtor, and for whatever reason it didn't sell. I did that for from December to April, and then in April I started to get the hang of it. So I decided to do what every smart person would do, and I burned all my bridges. I went ahead and I quit my bartending job and stopped taking training, people in personal training, and jumped into real estate full time. So it was a bit of a risk, especially because all of us that worked together with me, my father-in-law, my brother-in-law at the time, and my wife actually ended up joining this as well. We all more or less ate what we killed. So it wasn't like I was walking into some cushy salaried position. I was walking into sales. And once I jumped into that, it took me about 6 months to do my first deal on my own, but we ended up doing some deals in between as a partnership. And from that standpoint, moving forward, I haven't looked back. It's been going on 8 years now, and real estate investing primarily in the creative financing space, both in single family, commercial, and multis. And then also now been partner in our coaching, where we teach people exactly what we do in our family business on a day-to-day basis, and now are helping hundreds of people, going on thousands of people around the country, be able to build and scale their business this exact way, so they could be similar to me, which is escape from their W-2 and now to be able to build a fantastic business to create the life that they choose.
I love the background there, and like I said, burning all of your bridges, or burning the boats, or however you want to say that, and committing. I mean, that's a big, risky, scary step to be able to do that, and then to be able to go in, like I said, eat what you kill, and be successful in it. That's awesome. So let's talk a little bit about what the model was. You mentioned you're doing cold calling on expiring listings and that. What was the target, the prospect that you were seeking most? What did they have that you were looking for?
Yeah, so as a family business, and really what the model in which we teach our associates now, the people we buy and sell real estate with, is primarily approaching residential homes, where we can go ahead and acquire those residential properties through one of our three methods, which we kind of umbrella that as creative financing or buying on terms. Because we're able to go ahead and acquire these residential properties, we're then able to exit these deals a very specific way, because we have a very specific target buyer. Now, these are the buyers that are outside of financeability today, and they need time either for credit repair, credit enhancement, or seasoning. I was one of those perfect fits. To give you an example, when it was about a year into my real estate career, my wife and I were trying to move. It's about 2 years. We're trying to move out of Newport, Rhode Island, which is very city-driven, tourist-driven area, into one of the surrounding towns that we could start raising. At the time, it was about our 1-year-old son. So we ended up acquiring a piece of real estate on a lease option. So that's one of the methods in which we use, and we were able to buy and move into this home, be treated like homeowners, even though we didn't have our own loan yet. So that way we could work towards becoming financeable and becoming bankable, so that we can eventually go ahead and buy that home and put it in our own name. So that's a prime example of the people we work with, self-employed business people. So we have a very targeted end buyer, and that end buyer is what helps us create this 3 payday system in which we create cash now, monthly cash flow, and build wealth in these deals, because we exit with them. Because we know that end buyer in mind, we then are able to target specific properties, and really we target sellers that have challenges that the traditional market could not solve. Those challenges could be on one end of the spectrum. Could be, hey, they're in arrears, and they need debt relief tomorrow, which is becoming a primary targeted audience. I mean, I say targeted, primary people that we work with, especially as this market's shifting. And then we have the opposite side of the spectrum as well, and that is debt-free homes, free and clear properties, sellers that are in a great financial situation, and we would be looking for more of residual income, or to get a maximization of profits from that property, a property that they know, like, and trust. So we have this targeted sellers and these targeted buyers, and in between, as the real estate investors, we solve that challenge and bridge that gap, and that's how we're able to create these lucrative real estate deals without, like you stated at the beginning, without using large amounts of cash, raising capital, going to banks, personally guaranteeing debt, or signing personally on any loans.
No, I think what's interesting to me is that you first started talking about your buyer, not necessarily the person you're buying from, but you've got a pool. If I understood right, you have a pool of people that that you have, whether it be you've marketed to and you've identified, that for whatever reason aren't able to buy a home just yet, but they need a place. And tell me a little bit about that. I guess that's kind of what I'm curious, because I was thinking more in the front end of identifying the property that you're trying to acquire. But tell me a little bit more about the potential buyers that you have.
Yes, so roughly 60 to 80% of the nation cannot walk into a bank and qualify for a loan, even though they want to become homeowners. So it's a massive pool of buyers, and it's actually growing as interest rates rise. The amount of buyers in our pool, the people we work with, grows. Um, it's so relevant in the fact over the last 6 months, buyers that could qualify for loans at a 3% interest rate can no longer qualify for loans at a 5 or 6% interest rate because of their debt to income ratio. Now, it does mean that they're not good buyers, though. A lot of these people that were set up to become homeowners and now the market has pushed them out, have down payments or cash in their bank account. They are ready to become, they want to become homeowners. So we just help bridge that gap throughout that process. And then there's that large pool of buyers, very similar to myself, that are self-employed. And it's just what banks require, what we would call seasoning. For 24 months, you have to show that you make a certain amount of money so that they can then qualify you for a loan. Now, what most of us are taught as being self-employed is show the least amount of income if you don't want to buy anything, right? So you have to pay less taxes. But then as soon as you need capital or want to become a homeowner because you want a loan, you now have to switch that, which means that you and your CPA or your team now have to start showing that you're making more income. And that takes a transitional period. And we know, like, and understand that. So what we then do is we work with these buyers. We place them in homes in which we have acquired or own or control. They then come in with a non-refundable deposit that locks their space in, but it does get credited off the purchase price. They then are paying monthly rent on the property. And then in the future, they will then go qualify for a loan. And at that point in time, they will then pay us off. And then we'll either pay off the seller or we just get paid out because we have ownership, depending on the structure we did on the front end. So this is a massive pool of buyers that continues to grow as the market shifts. We've had many conversations. I'll plant the seed and then toss it back to you. Many conversations that as real estate investors, when there's a down market traditionally, it's an up market for investors because the investors then capitalize on the down market, which means it's buying season. So once it's buying season for us, we then have the ability to have more available inventory to now service these buyers that were kicked out of the traditional market or continue to be kicked out of the traditional market or just never thought that they could even be a part of the traditional market. And we show them that pathway to homeownership.
Got it. So we talked about your buyers and you mentioned kind of the sellers. I guess, is there an ideal situation? I'm just trying to think, because like a lot of times, like you mentioned, like there's people that you identified that they either own their property outright or they need to exit something right away, kind of thing. Yeah. Do you find these to be unique to a particular market, a particular segment of the market, or is this just universal across the board? There are opportunities up and down every block.
Yeah, it's universal across, not only across the country, but I mean, we primarily work in North America, across North America. The debt-free houses, there's statistics on that. It's roughly 1/3 of the properties in the United States are debt-free. So that's universal across the entire country. And then I've even heard, and again, don't quote me on this, but I've even heard that in Canada, it's even higher. Almost 40% of the properties are debt-free. So that pool alone is a massive pool of sellers that you could work with. And then the other standpoint is, look, there are always people that are going to be going through transitions in life, that are always going to have certain things with finances that may, bring upon a downturn for them and their family, death, divorce, unforeseen circumstances. And those are the people that we're looking to help. It's not the traditional sale that, they want all their cash today at a certain price. And it's like this, beautiful property that's going to get swallowed up by the traditional market, tomorrow. It's the houses and the people that just need a little bit of massaging or have a little bit of a challenge that we know that we can solve that the traditional market can't. And then there's starting to become right now a lot of sellers that are turning towards creative financing as well, because there's no reason why they have to pay, commissions if they don't need their money today. There's no reason why they have to go through the traditional means of selling a property where they have to go through 30, 60, 90, 180 days of kind of going through this, traditional cycle of dealing with banks. There's no need to, especially if, again, they don't need their capital today. But on the extreme side, and again, the focus, I believe, and we believe, is going to be in the segment where there's not a ton of equity in the deal. They may be in arrears because the shifting of the market, and because a lot of people have still not been able to climb out of this COVID-ridden area, or this last 2 or 3 years, and they're barely trying to make it out, and they're looking for a way to exit and to relieve themselves. And I believe that that's only going to continue. And we have a fantastic solution for that. And maybe you've heard of it before, but it's subject to deals, or buying property subject to the existing loan, which really gives us the ability to go in, pay down the arrears, or buy a property for what the seller owes, have the seller be able to walk away, not have their credit damaged for the next many years. And actually, in some circumstances, we've been able to increase their credit because we're now making the payments on their behalf, and they can walk away. And then we're able to now service that buyer that we originally talked about, because our buyers are willing to pay a premium on the house because we're giving them an on-ramp. So now, as investors, we can almost create equity in the deal because we can add a premium onto it and now create profits where there weren't originally profits, and where many real estate investors would have passed on, because the wholesale fix and flip world, it's, if there's no profit margins, they can't buy it, 40 to 60 cents on the dollar, then they pass it. And so we're able to really fill that void and now create a really great stream of income, not only for us, but then provide a solution for both sides of the party.
Got it. So if you were to guess the number percentage of deals that you guys acquire, you mentioned the ones with no mortgage versus the ones where people have either there's some arrears or they need to sell. How many of those, if you had to guess on a percentage wise, how large is the percentage of people that are in arrears versus the paid off mortgages?
Yeah, some estimates that come to mind based on our 3 strategies, and this was previous because we're actually making some strategic shifts right now because of the way the market is shifting.
Mm-hmm.
If I looked at 10 deals, I would say out of those 10 deals, it's going to be about 1 to 2 are going to be owner financing deals, so the debt-free houses. Another 2 to 3 will be the subject to deals, or the houses that don't have a lot of equity, and the remaining balance of probably 4 or 5 are going to be lease options, which really fall in between there, which is, the house has a mortgage on it, and the seller's looking for an alternative option in order to sell, but they also have equity in the house as well. So that tends to fall there. And the lease option is a really simple way to get involved in creative financing, and really a pathway in which we bring a lot of our brand new real estate investors through. Because the difference on a lease option versus those other 2 options are that the title does not transfer. It's a way to control an asset, way to control real estate, still be able to build an equity, a way to control an asset, but the title doesn't transfer. So it's a lot simpler of a conversation and a transaction with the seller, because you're really just drawing up a lease purchase agreement or a lease option agreement, structuring the terms of the deal. You then can literally move into that property or buy that property the next day if you chose to, even though we always build in contingencies to give our investors time in order to locate buyers. But that's a real simple transaction in order to get involved with. So I would say that's about half our deals. And then the other one's if I looked at 10 deal, get 10 deal block.
So let me ask you this. So the numbers there you described, you've got a couple out of 10 that are owner financing, and then you've got the other options where there's either no equity or they've got equity, kind of lease option kind of thing. In if you had to guess, how often does a buyer of one of your deals not perform, and if that does happen, what's the solution for the seller, or how do you? I mean, you just release it, resell it. What's the percentage of a fail versus, and then also what's the solution go forward?
Well, Darren, I'm glad you asked, because this is a major separator because of the systems and processes that we've created. to actually have buyers execute on these deals. Because if you've listened to any other podcast before with somebody, say like myself, you'd probably hear the opposite stats, and that is we qualify our buyers about 95% of the time they actually execute their agreements. Versus if you look at the rest of the industry, and that's why I say rent to own, people kind of like, does that actually work? Is because probably about 1 out of 10 actually survive. And the reason why this happens is because we have a very specific process in which we walk them through, where we not only us, but we utilize third parties that used to underwrite and also can measure the credit score, or if they need credit enhancement or seasoning. Well, we can create a mortgage readiness plan surrounding a couple pieces. One could be what's their down payment or their non-refundable deposit. Now, that non-refundable deposit is extremely important because it gives them skin in the game, one, but it also is going to help them qualify for better loans when they go get a loan, because that non-refundable deposit is credited towards the purchase price and is going to be shown when they go buy the house. So that's number one. And throughout their lease term, because they have a specific time frame based upon what we get back on their mortgage readiness date, we'll then create a customized agreement around that. We will help them increase by having them put down more down payment money throughout their term, which that again increases their down payment, which helps with their loan. But what it also does is it puts their feet to the fire and always keeps it top of mind that they are investing in buying this property to become a homeowner, versus you put a down payment now and in 3 years from now we hope you perform. That's more than likely not going to happen. Too much time it happens in between those. So that's the first piece. And also based upon that down payment, we'll also look at their credit score. All right, where are they today and where do they need to be in order to qualify for that loan? Or are they self-employed and they need 24 months to show? How much money do they need to show in order to qualify for that loan? And then throughout that term, we will have them be a part of one of the third parties that we work with that will maintain and check and help them increase their credit or show and increase their seasoning. So now they really have not only us as the investors, but we're also bringing in specialists that help people get to that point. So we walk them through a very specific program. That is very important to us, because when we entered into this industry, and now we have over 50 years of experience in real estate between myself and my team, my father-in-law and my brother-in-law. When we walked into this, we noticed that there were too many people in our space shouting from the rooftops that, hey, you can place buyers in the property, collect non-refundable deposits, let them go there, and if they default, whatever. It doesn't matter. You just do it again, and you do it again, and you do it again. Maybe legally that's okay, but morally and ethically, that's not something that we stand by. So we wanted to really create a system that would generate buyers in order to get them to the finish line. Now, I'll answer the second part of your question, which is what happens if they actually do default? Well, if they default, then unfortunately they are going to lose that non-refundable deposit, and they would have to move out of the property. And then depending upon what type of structure we bought the property with will determine our next exit. If we bought the property, we have plenty of time left over, meaning before we have to either exercise our option or pay off a balloon payment, then we may stick another buyer in the property or work with the next buyer to help them qualify for loan. If we have a short time frame, then we may look at some alternative options like selling it traditionally, or maybe even renegotiate with the seller in order to get a better terms. So there's many different ways in which you can pivot. And I'll be honest with you, any time in which we needed to pivot in any of our deals, whether it's us or us partnering with people and doing their deals in their neck of the woods, there always ends up being a better solution and actually increased profits, because it allows you to reevaluate that deal and kind of pull on some different levers in order to create a better exit.
I appreciate you going through that, because I think that like you indicated, I think the notion amongst most investors is like, it's a great deal. And if they fail, then good for you. You get to do it again and again and again and again, as opposed to like creating an actual success stories there. I'm curious. So let's talk about the investor. You guys as the deal makers and your students, describe where is the cash flow and the spread? How are you guys making your money? We've talked about buying the properties from the the sellers on a couple different ways. We've talked about the buyers and how you put them in and get them to be actual buyers. How are you guys making your money, and how do your students make their money?
Yeah, let's talk about what the people actually want to hear about on the podcast, and that's how
Cash
they get
flow.
paid. Yeah, exactly.
Cash flow,
We teach
baby.
them at the beginning, and then we're
Right.
talking about solving all these problems.
Right.
So our trademark 3 payday system works like this. So when you go ahead and you acquire a piece of real estate, you're buying the property from a seller, you're going to agree upon typically 3 different terms. One is going to be the purchase price or the locked in amount of equity. We tend to operate in equity. That way we can create principal pay down in the deal, even if we don't own it. So you're locked in equity. Then secondly, you're going to have your monthly payment, which could consist of, if it's owner financing, it's what you create with the seller. A large portion of the time, we actually create principal only payments, so 0% interest monthly payments. If there's an existing mortgage, then you're going to be paying the principal, interest, tax, and insurance on that mortgage. You're going to be paying the PITF. Then the last term tends to be the term, or when the property needs to be cashed out. On some of our deals, there's no end date. Like on the subject to deals where there's no equity, we just go ahead and we acquire this property, and at some point in the future, we'll pay it off. There'll be no end date. If it's an owner financing deal, some of those could range from a 30-year mortgage to a 5-year balloon. Lease option, same thing. It could be a 10-year deal to a 3-year deal or a 5-year deal, and anything in between. So then there's that end date that things need to be cashed out on. So once you agree upon those terms with your seller, you're then going to sell the property. So you're either going to take ownership from a purchase and sale agreement, or you're going to buy it on a lease purchase agreement. And that will give you equitable interest in the property and now allow you to sell it. So now you go ahead and you sell it, and we exit our deals one of 2 ways. We either exit on a rent to own or a lease purchase, or we exit on owner financing, where we now become the bank. And there's techniques and tools that we use along with our attorneys in order to now structure where we now become the bank. And we are going to now sell that property for a higher purchase price, because our buyers need time in order to qualify for loans, so they're willing to pay a premium. We're also going to sell it at a higher monthly payment. And then typically we're going to sell it at a shorter term. So that way we have the ability to make any pivots if for some reason this buyer isn't able to qualify for a loan. Also, one of those could be that we give them extra time. Others could be that we take back the property. Now that we've constructed both the seller and the buyer, what we're going to do is we're now going to collect a non-refundable deposit from our buyer, which is our payday one, which tends to be anywhere from 3 to 10% down, and sometimes up to 20% over time. Then our payday 2 is our cash flow, our residual income. Remember, you're not a landlord. You're just simply collecting a payment and then paying what the seller or the mortgage company. So it's just residual income coming in. That's your payday 2. And then your payday 3 is going to be the equity that you built into the property, which simply consists of 2 different things. One is if there's any premium left over, and 2 is the principal that has been built into the deal over time. Give you one example. Let's say you buy a property and you're making a monthly payment of $1,500, and $500 of that is coming directly off the mortgage, or is the principal portion of it. Every single year that you're in that deal, $6,000 is coming off the mortgage. Because you locked in the equity with the seller and not a purchase price, you are the beneficiary of the principal payment. That is how you can even create equity in a deal without ownership. That's why those lease options are really easy for people to get involved in at the beginning. And then as the real estate investors start to do more and more deals, we continue to help them up-level their game by getting and owning real estate through owner financing and subject to deals.
No, I like the multi-prong approach there with multiple revenue streams there. You get the deposit, you got the cash flow, and then the equity on the backside. That's awesome. We've been primarily talking about, or at least the conversation's been focused primarily on like residential properties. Can you tell me a little bit about some of the commercial properties you found that work, or some of your students have found as it were, does it
Mhm.
work with commercial properties?
Yeah, absolutely. So we purchased a couple multifamilies. There was a 6 unit, and I remember specifically. It was when I first got involved in real estate. I was sitting there, and my father-in-law Chris was actually purchasing it with his IRA, a 6 unit. We acquired it from a seller who inherited the property. We would just do direct mailings to these, very specifically targeted mailings to commercial real estate, multis or commercial, in very targeted areas, because we knew and liked the management company that was there. We went ahead and we acquired that piece of real estate. And I remember at the closing, because we purchased it the very first or second day of the month, the seller had to hand over all of the security deposits and the rent. So we actually get paid $7,100 at that time of closing. And we ended up buying it on owner financing, and it was principal only payments. I believe it was like $1,500 a month, principal only payments. We went in, of course, tightened things up, added some additional revenue streams to it, and went ahead and we ended up exiting that deal. Instead of refinancing and keeping it, we ended up exiting that deal and selling it to another company that was coming in and buying units. And it ended up being over 6 figures in about 24 months on that turnaround on that 6 unit. So, and that's the power of owner financing and principal pay down of 0% interest, is you can create massive amount of equity in a deal really quick, especially as you're increasing rents over a short period of time. So we ended up doing that. That's a great example of multifamilies that we work in. We tend to work in 10 units or less, specifically because they're mom and pops usually own them, and it's a lot easier to, kind of work with mom and pops and structure these types of transactions. Even though we've been presented recently in the market, our 18 units, 21 unit mixed use buildings that were open to these creative terms. I'll give you one more example. The commercial building, it's a mixed use building that we bought, is actually our home base, and our the housing all of our companies. It's right outside of Newport, Rhode Island, which is a very prominent area. And we ended up purchasing this property from a seller who ended up passing away recently for estate planning purposes. He had a building. He might have known. He was getting older. He still had his son and his wife were still around. He was a big landowner and commercial real estate owner. And we ended up structuring owner financing on that deal over a 20-year term. And once he passed away, we just continued to pay his estate. And I remember we got a phone call from his wife, and she just thanked us for continuing to make the payments, even though he went through this transition, and because she lives off it from all the real estate investments that they created. So another fantastic group of people to work with are people that are doing this strictly for estate planning purposes and don't want a lump sum, but they want to create this residual income, especially as they may be leaving family members behind, and they want them to benefit from that piece of real estate that they created. Now we of course fixed this thing up, and we did a lot of work to it, but it's raised in equity almost $400,000 over the last couple of years because of the improvements and that we made to the commercial building. But fantastic deal for both parties.
No, that's awesome for both you, and appreciate you kind of sharing the commercial aspect of that. Trying to think, there's something else we talked about commercial. Seemed like there was something else I meant to ask you, and lost a thought there. But anyway, let's shift gears here for a second, if we could. By day, I'm an insurance broker, and I try and work with my clients to assess risk and determine what to do with the risk. And there's 3 strategies we typically consider. We first look to see if there's a way we can avoid the risk. When that's not an option, we look to see if there's a way we can minimize the risk. And if we cannot avoid nor minimize the risk, then we look to see if there's a way we can transfer the risk. That's what an insurance policy is. And as such, I like to ask my guest if they can look at their own situation. Could be their clients, investors, tenants, the market, interest rates, whatever you consider to be the biggest risk. And for clarification, again, while I'm an insurance broker, I'm not necessarily looking for an insurance related answer. And so if you're willing, I'd like to ask you, Zachary Beach, what is the biggest risk?
Yeah, this is a fantastic question, because it's something that we talk about quite often, and it's something that we talk about a lot with our students, and that's because we help a lot of students leave their corporate jobs and become real estate investors or become business owners, because it's our big belief that the W-2 is the biggest risk. The W-2 is the biggest risk because you have zero control over the outcome of whether or not you have a job or not. There's too many other parties involved. There's too many other people that can control your destiny. It's not until you put the risk or you go outside your comfort zone and start building the life that you choose through either real estate investing or business, that way you can start taking control of your life. No, all the predictions are right now that we're about to go into a downturn. I mean, nobody can really predict it. I mean, the billionaires can't predict, but the feeling is that we're shifting. And when there's a shift, there tends to be layoffs. There tends to be, because businesses now start cutting back on their labor, and they start, really consolidating. So you just never know if you're the one that's going to get cut back on as being, inside a W-2. So that is why there's a large group of people that are consistently, and we're starting to see it, are consistently applying to be, in our programs that have corporate jobs, and they're looking to first and foremost offset expenses by building a real estate portfolio. And then secondly, once they go ahead and build that portfolio, create a transition plan to now be in control of their business and be in control of their lives. And the amazing thing is, once you see people transition and escape that job, the new life that's built into them in the acceleration process of their life, personal development, their wealth, how it dramatically starts increasing once they have full control of it and can consistently, day in and day out, work on building that better life. So the W-2, in my eyes, is always the biggest risk when it comes to, I would say, real estate investment, when it comes to you personally inside your lives.
Very, very, very well said. I think taking control of your situation, and also recognizing opportunities, and what's that old adage? You give a guy a fish, he can eat for a day. You teach him how to fish, he can eat for a lifetime, kind of thing. You learn something, and you can apply that skill and grow your assets and have a more secure future for you and your family. And it's definitely a good way to go. So, Zach, where can listeners go if they'd like to learn more or connect with you?
Yeah, I'd love to ensure that each and every one of your listeners actually gets our Amazon bestselling book, Real Estate on Your Terms, as I think that can be a fantastic first step for you to, avoid the upcoming risk of your W-2 and really getting involved in real estate investing. So the way you can find it and go grab it, we're going to ship it to you for absolutely free. It'll be a hardcover book. You just go to wickedsmartbooks.com/CREPN. wickedsmartbooks.com/CREPN. Go ahead and grab your book, and we'll ship it out to you as soon as you go ahead and fill out a quick form.
Awesome. Well, Zachary Beach, I can't say thanks enough for taking the time to talk today. I've enjoyed it, learned a lot, and I look forward to doing it again soon.
Awesome. Thanks, Darren. Appreciate your time.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.